If you own rental property in Canada, the Form T776, which is called the Statement of Real Estate Rentals, is your annual requirement to the CRA, the Canada Revenue Agency. This form is key for reporting your rental income in Canada and for you to understand your tax obligations as a landlord. And in this video, you're going to learn everything you need to know about the Form T776, what income to include, what expenses to include, how to actually fill out the form, and everything else about this form so you can manage your tax obligations when it comes to your rental income. The T776 form is your go-to form for reporting your rental income and expenses related to that rental income to the Canadian government once a year during tax time. So if you've ever wondered, how do you go on about reporting your rental income? What forms do you have to fill out? When do you have to fill them out? Your answer is the T776 Statement of Real Estate Rentals. In this form, you're going to include all the income that you generate from your rental property or properties based on however many you own. Doesn't matter if you own one or many, you have to include all of your income. And next, you're going to include all the expenses that you've incurred that's related to that rental income. And once you take your income, you subtract all of your expenses, what you are left with is your net rental income. And don't worry if you don't know what expenses to include right off the bat, because that's what this video is for. I'm going to go into detail on what expenses you can include, what expenses you can write off on your taxes. Alongside your regular tax return, the T1, the T776 ensures that your rental income is accurately taxed in Canada, because you don't want to pay too much taxes and you don't want to get in trouble for paying too little taxes. So that's why it's so important that you accurately fill out this form from top to bottom. And this form is designed for all types of property owners. Whether you are a single property landlord or managing multiple properties, doesn't matter. Properly submitting this tax form will allow you to unlock some key financial benefits, namely being able to track and taking off expenses against that rental income. And that is going to be key for you to avoid paying too much in taxes. So this question I hear all the time: is rental income taxable in Canada? The short answer is yes. Just like every other income, whether it's employment income, interest income, investment income, dividend income, capital gains, you name it, rental income is taxed in Canada. Now, while it may sound simple that you should report your rental income to the CRA and you're done, it can be a little bit more tricky because you need to track every detail when it comes to your rental property. For example, how much rent are you collecting from your tenants? What other services are you providing to your tenants that you charge a fee for? All that you need to report. And you have to make sure you are reporting all rental income and all services you provide to your tenants where you are charging money accurately to the CRA to avoid getting into trouble. So let's do a quick example. Let's say you own a property in downtown Toronto. For argument's sake, you own a condo. And your tenant pays you $2,500 a month for this condo. And that $2,500 is your rental income, which is fairly straightforward if you're with me so far. And most property owners are going to experience this exact nature of transaction. You're going to rent out a property and your tenant will pay X amount for each property, each unit you have rented out. Fairly straightforward so far. So going back to this example, so far you've already collected $2,500 in rental income. But on top of that, let's say you decide to charge an extra $200 for utilities, which covers water, heat, and electricity. So that means your total rental income per month from this condo is now $2,700. And that is your rental income that you are going to report to CRA. Now this next part is where I get the most amount of questions, and it's probably why you're really watching this video, because rental income may be straightforward in terms of what you have to report. What about expenses? What expenses can you write off on your taxes when it comes to rental property? There are several expenses that you can claim on your T776, and a lot of these expenses most people don't even know about. And because if they're not reporting these expenses correctly on their tax return, what that means is people end up paying thousands of dollars in extra taxes that they don't need to. So make sure you're paying attention to this one, because this will allow you to save on taxes every time you file. So what expenses can you claim? Let's go through the list. Mortgage interest. You can deduct mortgage interest from your rental income. Keep in mind this is mortgage interest, not your entire mortgage payment, because when you make a mortgage payment, there are two components. One is your mortgage interest, which is a tax deductible expense, and the other part is your principal payment, which is effectively your equity. So the interest component is a tax expense, not the entire mortgage. Next, property taxes. You can claim those. You can claim insurance costs. You can claim utilities only if you are the one paying those utility costs, not the tenant themselves. Going back to our previous example, we talked about how you are going to be charging a $200 flat fee for utilities. So in this case, yes, that $200 is part of your rental income, but the expenses, let's say you end up paying $300, or let's say you end up paying $100 for utilities, for water, heat, electricity. That is your expense. So your income is going to be $200, that's the flat fee you collected, and the expense is going to be the $100, $200, whatever the actual expenses you are paying for those utilities. So that is tax deductible. Again, only if you pay for them. Next, maintenance and repairs to keep your rental property in good condition. Property management fees, that is also tax deductible. Advertising costs, yes, that is also tax deductible for your rental property. It's crucial that you keep detailed records for every single expense you're going to claim on your taxes, especially if the CRA is knocking at your door and looking for an audit. You want to make sure you have support and backup for those claims of expenses you are going to make. And claiming these expenses on your T776 form is going to reduce your taxable rental income, meaning the more expenses you have and that you are able to claim, the less tax you're ultimately going to pay. Now, what if you only rent out part of your home? For example, you own a single detached home, or let's say even a semi-detached townhouse, doesn't really matter. But what if you rent out your basements? You're not renting out the entire property because you live on the main floor, the main property, and you're renting out your basement. What do you do if that's the situation? Well, that's actually a very common scenario. So when it comes to property expenses, you're going to prorate based on the percentage of your home that you're renting out. For example, let's say you rent out your basement, and that basement makes up about 30% of your property. That means you can take 30% of your expenses that are related to that rental property and claim them on your taxes on this T776 form. What is the difference between operating expenses and capital expenses when it comes to your rental property? Most expenses you're going to claim on your taxes are going to be called operating expenses. And these expenses are exactly what they sound. They are operating costs to keep your property running daily. And these are the expenses we just talked about in the last segment where I listed out all the expenses. Those are called operating expenses. It's important to know the difference between operating expenses and capital expenses because they are recorded and taxed differently on the T776 form. For example, capital expenses may include things like installing a new roof, installing new windows, installing a new HVAC system. You get the idea. These expenses improve the condition of your property over the long term. That's the key difference. And these type of expenses, the ones that improve your property over the long run, the capital expenses, you can't deduct them right away because they are capitalized and depreciated over a certain period of time. And this depreciation is called capital cost allowance, or the CCA rate. Understand the differences between capital expenses and operating expenses is key to saving you taxes when it comes to filing, because you don't want to overpay your taxes because you are miscalculating an operating expense as a capital expense, or vice versa. So one, it's important to keep detailed records, and two, understand the differences because they are treated differently when it comes to operating and capital expenses. Now that we've talked about what the CCA is, the capital cost allowance, how do you actually go on about calculating the CCA? So let's talk about that. Calculating the CCA can be a very beneficial strategy because it allows property owners to reduce their taxable income by claiming the CCA on their taxes. One example where you can use the CCA strategy is by claiming the cost of the property itself over several years, because this approach allows you to recognize the wear and tear of the property as it ages. As we all know, a building, a property, etc., it will naturally age over time, wear and tear, and the CCA allows you to claim that type of wear and tear. For example, let's say you purchase a property for $400,000 and it falls under Class 1 CCA, which has a rate of 4%. First step in calculating your CCA is to determine the depreciable amount, which is typically the purchase price minus the value of land, because land is not depreciable. Because you've paid $400,000 for the entire property. That property includes the property, the building, the unit itself, plus the land. You have to figure out what is a non-land component, because land you cannot depreciate. Land technically appreciates in value, it doesn't depreciate. So going back to the example, let's say the land is valued at $100,000. Then the building, then the property itself is worth $300,000, because you have $400,000 as your total property. The land is worth $100K, so you're left with $300K for the property, for the building itself. In the first year this property is available for rent, you can claim up to 4% of the $300K, which roughly translates to $12,000. However, for the first year, you have to apply something called the half-year rule, which means you can only claim half the CCA. So instead of the $12,000 you claim in your first year, you're only going to claim $6,000. This $6,000 deduction is going to be used to reduce your taxable income, meaning you, at the end of the day, end up paying less taxes and more money just stays in your pocket. Now that may sound too good to be true, that you get to arbitrarily reduce your taxable income by claiming depreciation on your property. There is a caveat to this, because the government, they always want a piece of that income pie. They want their tax, so whether now or later. So the caveat is that if you are going to claim depreciation on your property, you're effectively also reducing something called the adjusted cost base, or the ACB of the property. Now in my other videos where you've seen me talk about ACB when it comes to the stock market, you know that when you sell your shares, the lower your ACB, the higher the capital gain. And if you don't know what I'm talking about, make sure to watch this video where I talk about capital gains tax in more detail. But in this case, if you're going to lower the ACB of your property by claiming depreciation, and if you end up selling your property much higher than the ACB, you're going to have a natural larger capital gain. Just like with the stock market, the bigger the difference between the fair market value, or the price that you sell at, and your ACB, the larger the capital gains tax. Same thing applies to property. So that's something you want to consider if you are going to claim depreciation on your property. You don't have to, but something to think about if you're going to go down this route. Rental income and business income are not the same thing. I can't tell you how often people reach out to me confusing the two. So let me say this once more in case you missed it the first time around. Rental income and business income are not the same thing. And how do you differentiate between the two? And trust me when I say this, understanding the difference between rental income and business income is crucial when it comes to filing your taxes, because again, you don't want to overpay your taxes. That's not good for your pocket. And you don't want to underpay your taxes, because the CRA will then come after you. So here's how I want you to think about rental income versus business income. Rental income is from your rental property, because your tenant pays you rent for your rental property. That equals rental income. Fairly straightforward. But let's say you've been at this game for a long time and you decide to acquire a hotel, as an example. Technically, if you're renting out the rooms in your hotel, is that rental income? Not really. So in this case, because now you're becoming more of a service business, you are providing hoteling services because you own a hotel. So in this case, that is no longer classified as rental income. It is classified as business income, because you are in the business of providing hotel services. So keep that example in mind if you get confused about when is it business income and when is something considered to be rental income. Different tax implications. Similarly, if you convert one of your properties into a short-term rental, think of like vacation properties, Airbnb, etc. Instead of just collecting rent, you are now also managing bookings. You're also providing guest amenities and guest services. You're also marketing your property. This may be considered to be business income, because now you are more actively involved and you are seeking to generate more than just rental income exchange for a place to stay. This type of services can be seen as business income. In my next video, I'll be taking what we've learned here today and show you step by step exactly how you can, in real time, fill out a T776 form. And I'm going to be showing you, using Wealthsimple Tax, every single step you need to take in order to successfully fill out that T776 form. We're going to go through all 5 components of T776, from identification to motor vehicle expenses to CCA, so you know exactly how to fill out this form for your investment properties. So if you are interested in a video like this, I want you to hit that like button, make sure you hit subscribe so you know when this video comes out. And also let me know in the comments, what exactly do you want covered? What are some of the scenarios that you are seeing or facing maybe yourself that you want me to cover in that next video? So definitely stay tuned for that. And last but not least, I have a whole bunch of resources for you in the description down below. So definitely make sure you check them out. You're going to find something worthwhile, I'm sure. That's it for now. I'll talk to you in the comments section.